Most of the time, when you buy something, you expect a 2% decline in the stock to cost you 2%, and a 2% rise in the stock to make you 2%. But what if you could change that? What if you can make more when things go the right direction and lose less when they don't go your way? More consistent, reliable returns. This is what traders and investors want from their trading and investing. In this video, I'll explain the 3 things that you can use to have a higher level of confidence that you can navigate your trading and investing with the outlook of having more consistent profits and no losing years. My name is Andrew Falde, and I'm a full-time professional trader and investor and author of Skip the Dip. As a professional, I manage multiple accounts for clients and myself. Now, no one can tell you that managing money is always easy. I have losing strategies, I have losing months, even losing quarters. But altogether, I have personally been able to go for many years now without a losing year. And this isn't just because I bought stocks during a bull market, because most of the time I don't buy stocks. Instead, it's because I use the principle that I call true diversification. And this is the principle that's discussed most in Skip the Dip. So today, I want to highlight 3 things that you can use to become truly diversified, so you can have a higher level of confidence that you'll be able to navigate any market, even bear markets and crashes, with the expectation of having your risk under control and ending each year with a profit. And before we get into the first principle, I want to explain one misconception that most people believe, and that is that they believe trading and investing are 2 completely different things. And while there's some truth to that, what is not true is that you can only choose to be a trader or choose to be an investor, or that your trading activities and your investing activities should be completely separate from each other. And that's what this first principle is all about. Principle number 1 is that your trading can improve when you apply intelligent investing principles. You may have heard the old saying, don't let your trade turn into an investment. And that refers to those unfortunate trading situations where traders lose sight of their trading objective and refuse to admit they're wrong. So they don't close a bad trade and they let it become a long-term position, often while losing more than they originally expected. And when this happens, a trader has turned a bad trade into a bad investment. But what if you reverse this? What if you make good investments turn into good trades? And the only way to do this is to first understand good investments, and second, understand great trade entries and exits. And when you do, and you line these 2 things up, you can define your risk much better on investments than someone who's just buying and holding, and you can be more selective than most traders, who often just look for technical patterns without filtering for ones that may have more upside because they're also great investments. All right, so here's an example where we'll compare investing in a stock that has strong fundamentals versus trading a stock that has strong fundamentals. All right, so here's the price chart of the stock. And it's a strong stock, a strong industry, it's large, it's innovating, it's growing. But what happens next is that the stock loses 25% of its value. And a buy and hold investor would have to ride out that drawdown. And many investors get very nervous when a company's value drops by more than 10 or 20%. They start to wonder if they're wrong about the fundamentals of the company, the industry, or the entire economy. But what happens next? The stock recovered and rose 46% from the bottom of the sell-off. If the investor joined the crowd and bailed out when the stock was down more than 20%, they could easily have missed the recovery and been forced to now buy much higher if they ever get back in at all. Now, we'll look at trading this same stock that has strong fundamentals. And on the chart, you can see some things have been added, okay? The red and blue dots are places to sell if the stock is dropping, and the green triangles are places to lock in some profit if the stock is rising. And this trading model is currently long. It was entered at the beginning, and it's been holding right up to that same point that we looked at before. And what happens next is that 25% decline in the stock's value. The trading model has an exit though, and that's called a big extension trailing stop. And that means if the price gets too far away from the first trailing stops, another one's actually placed closer to the current market price to exit if the price starts to drop out of the sky. Then the trader is able to re-enter after the dust settles and is actually still holding this position as of the time I'm recording this. So the result is, of this example, the trader avoided a 20% drawdown, and the trader has a clear plan to enter, exit, and re-enter. No confusion. And even if the fundamentals of the company had changed quickly for the negative, the trader can exit early and stay out instead of hoping things turn back around or trying to predict whether or not the company is going to continue to be successful or not. And that brings us to the second principle, that proven trading techniques can help you control risk and maximize returns without predicting. See, most people think traders are trying to predict when something will happen and time the market perfectly. But that's not how good trading is done. Excellent trading is not about predicting. It's about opportunities and risk versus reward. And when you focus on great opportunities, whether it's fundamentally strong stocks or rare technical opportunities, and you define favorable risk versus reward, then all you need to do is execute over and over again. Now, before I get into principle number 3, I need to tell you one thing, and it's just because if you have an opportunity and you define great risk versus reward, you still have to realize some of those risks. So keeping your size under control is very important too, because if you do everything right, but you do it at the wrong size, you can wipe out your account using a winning strategy, because the normal losses in a larger account would be too big for you to recoup in a smaller account. All right, so to recap what we've covered so far, you can have a fundamentally strong investment, but have to ride out large drawdowns and periods of uncertainty. But if you use good trading techniques like the one we looked at earlier, you can avoid some of those losses and define your risk better. And that same signal I showed you, the one developed by friend and member of our community, Eric Hoyle, is one that works very often even when the stock isn't necessarily fundamentally strong. So the real power, and when things get very exciting, is when you apply a proven trading technique, one that tends to work on most markets and most time frames over the long term, and you combine it and you put it on top of intelligent investment opportunities. Okay? So now I'll share the third principle, and this is one that deserves a lot of time and attention, more than I can give it right now, but I want to introduce you to it now anyways. It really would be enough to just combine proven trading techniques and intelligent investment opportunities, but this third principle provides a huge advantage to those who understand it. And the third one is called structural edge. All right, so let's take a step back and think about it from a different perspective to help make it clear. Imagine you're an entrepreneur and you knew that the fundamentals of a certain industry were very strong. So you decide to start a business in that industry. And most people believe that there are two ways to finance a business, which is either with debt or equity. You can either borrow the money for the business, taking all the risk of that loan, or find investors to put up the capital. With investors, you give up a lot of the profit share, but you have a lot less risk because there's no debt. But with debt, you can have all of the net profit for yourself, but with higher risk. But what if there was a way to have the benefits of investors without giving up so much of the profit? What if you could have the profit potential of using debt, but the safety of not having debt? If you know how to structure deals, then you could do this. You could offer an equity investment into your business that included a buyout. And so say your investor puts in $100,000 for 50% of the business. If you included an option to buy out the investor, then you would have the right to buy the investor's share at a predetermined profit. So here's how this provides structural edge to the entrepreneur. If this business is successful, then you can use your earnings to buy out the investor and have 100% of the upside after that. The investor is happy because they got exactly what they hoped for, the predetermined profit point that you agreed upon. Then, if the business fails, you cut your risk in half because you didn't use debt or fund it all on your own. Obviously, doing something like this takes more work and is more complicated than just going to the bank and getting a loan or taking all the risk yourself. But the advantages are too obvious to ignore. So how do we apply this to trading and investing in the markets? Well, just like the option we talked about in our business deal example, there are options on stocks, indexes, futures, and ETFs. So right now, I'll give you one example. Most of the time, when you buy something, you expect a 2% decline in the stock to cost you 2%, and a 2% rise in the stock to make you 2%. But what if you could change that? What if you can make more when things go the right direction and lose less when they don't go your way? I bet you can see why we call this structural edge. All right, so here's the trade. Now, what I'm going to show might be very new to you and very foreign, but trust me, it's not very complicated once you learn it. And for those who are experienced with options, you may recognize how this works right away. Either way, if you are confused by this or you find it to be very simple, just stick with me for a minute to show you this quick example. And that's all it is. It's just an example of setting up a financial structure that gives you the advantage almost immediately. Sound good? So one name for this, it's called the Hedged Risk Reversal. Kind of a cool name, right? I didn't make that up. I wish I did. I actually don't know who came up with that name, but I like it. I used to call it the triple layer cake trade. And well, I still do sometimes for the traders in my group, but who are, they're used to me calling it that. Anyways, here it is. There are 3 options that we trade instead of the stock. We buy a call, so we're long a call. We sell a put, and we buy a put. And that long call gives us the rights to the upside for a small cost. And the put that we sell gives us money to pay for the cost of the call, but comes with the obligation to buy the stock at a lower price. And the put that we buy is a hedge against the risk that comes from the put that we sell, all right? And if you're familiar with options, you'll see this is a combination of many different types of trades. In one sense, it's a put credit spread and a long call. In another, it's a long strangle with a short put. But the simplest thing to see is that it's a risk reversal with a hedge. A risk reversal is selling a put and using the money, more or less, to pay for a long call. Again, if you don't understand what any of those are, don't worry. You'll understand better in a minute. All right, so let's start by understanding how the risk reversal works. Okay, so here you can see we buy a call above the market. So the stock price goes from left to right, so our profit and loss goes up and down. And the current price is in the middle, and if the stock price goes up, we are profitable. If the stock price goes down, we lose money. But in this, with a call, we have unlimited upside. You can see that as the price rises, our profit becomes exponentially larger and is much larger than any of our downside. And our downside is just a small cost. But it must go, the stock must go up more than 10% by expiration to be profitable. That is the trade-off. You have unlimited return and reward on a much smaller amount of risk, but you have a limited amount of time and it has to go a certain distance before it kicks in. Okay? And so what we do is, to pay for the cost of the call, we sell a put. We sell a put that pays actually more than the cost of the call. In this case, we actually get paid a credit to put on this trade. And now the trade can be profitable even if the stock drops as low as 5% below where we got in at expiration. So now you're trying to be in something and make money if it goes up, but you can actually still make money even if it goes down a little. But the risk and reward are almost the same now. Before we had a very small amount of risk. Now we have a large amount of risk and a large amount of potential reward. But we do have a wider area where we can be profitable. It's not just up is profitable and down is a loss. Okay, and this is where the fun really begins. That was a risk reversal. We're going to take it beyond that and look at this hedged risk reversal. And what we do is we buy the lower put further away from the market for less than the net amount you were paid for the risk reversal. So even in this scenario, we actually still get paid just a little bit. So what happens now is we have that benefit of the small loss. We have a max loss that's around $2,000. And the max gain is actually still unlimited. You have an unlimited profit potential with a limited amount of loss. But originally, remember when we had the long call, we had both of those, but the problem is it had to move before you can make money. In this now, you can still earn income if the stock stays in a range or even drops as much as 5% by expiration. Now, I'm going to show you a modified version. This just tweaks things a little bit more and makes it can be even a little bit more exciting. The break even in this one, all we've done is we've moved the strikes around. We just changed where everything is a little bit. The break even if the stock stays in a range. That's our objective here. Is we want a lot of upside and very, very little risk, and we want a wide range. Okay, so we have a break even if the stock stays in a range. So basically if it stays anywhere from here to here, it'll stay in a range. And that break even point, if the stock drops, is as much as 12% below the market. So the stock can drop more than expected. It can drop more than 10% up to about 12%, and you break even on the trade. And the profit of the stock rises actually kicks in at 8%. All right? So where else could you see a structure like this? Only with an options trade, with an intelligent, well-built options trade where you have structural edge. Can you see an example like this, where when you're right, all you have to do is see the stock go up by 8% or more to be profitable and have unlimited profits. And for you to have any losses at all, the stock has to go down more than that. It has to go down 12%, not just the same amount, but 12% below before you start to lose money. And even then, the potential loss is limited. It is less than your potential gain because your potential gain is unlimited on the upside. All right? So, today we've just scratched the surface of what it means to use intelligent investment opportunities and apply proven trading techniques and use structural edge to increase your profit potential and limit your risk. And if you found this to be interesting and helpful and you'd like to continue learning more, then I invite you to take the next steps. So first, just go ahead and subscribe to this channel and set alerts to get more lessons and ideas and examples. And second, click the link in the description to watch a free presentation to continue learning about the strategies and techniques that we use for trading and investing. All right? I'm glad you spent some time with me today, and I look forward to sharing more with you in the future. So go ahead and subscribe now, then click the link to get access to our free presentation.